we fundamentally believe that the access shouldn't be limited to those that, are the wealthiest.
KK, great to see you.
Nice to see you.
I would love you to take me through your path at JP Morgan that landed in this seat.
Okay. It started in 2008. Just graduated school. It was the summer of 2008. I actually started as a credit analyst in the Chicago office, which is the old bank one where a lot of our credit was done out of. I had always started on the wealth management side as part of the private bank, although there was lots of crossover business to do at the time. And I was a credit analyst for a few years. I thought markets going down 3 to 5% a day was normal. It wasn't. But we were in a fortunate position to be JP Morgan at that time. After 2 years in Chicago, I moved to New York to work in the office of our head of investments and our CEO. And that was an incredible experience because we were, hiring, building new products, especially in the world of alternatives in the sort of 2010, 2011 era. We sort of changed the way in which we offered things to our clients, which was fascinating, which we can get to. And then in 2013, my then boyfriend of many years, now husband, and we've been together for over 20 years, wanted to go to business school. And so I moved to London in 2013. Tons of change going on in the alternative industry there because of AIFMD and the UK tax status changing and everything. And alternatives was at this sort of turning point about what was the future of it going to be within that region. I got a chance to run our Europe and Middle East business because we do function as a global business. Moved back in 2017 to run our US platform. And then in COVID, had a chance to take over our global business at the end of it. So it's been a couple different cities and a couple different countries, but that's been 17 years at JP Morgan.
So working your way up in private wealth, how do you think about putting a scope around what JP Morgan's private wealth business is?
The overall business? It's a lot. The earnings reports and stuff will come out with the, almost $3 trillion that we have within that space. Alternatives as a piece of that is significant. It's not as significant as the portfolios that we manage on behalf of clients, which is almost $500 billion. But a lot of what we do in alternatives, which is about $178 billion, where we allocate to a lot of non-JP Morgan, but also JP Morgan portfolios, is a piece of the portfolios. The client base themselves, I think, is what differentiates us in terms of that scope. So a lot of that is, it's anyone that has a few $1 million to several $1 billion. And I would say, if you include our full wealth spectrum, it includes Chase, which is 1 in 2 households in America, all the way through to the institutional side. Private bank in particular, we'd been focused for the last many years on families that had anywhere from $5 million of net worth and above. And then those that participated in alternatives, partly by nature of it, because they had to be qualified, skewed higher. But we have incredible insight because we cover 1,400 of the 1,900 billionaires in America. We cover a decent amount of those outside the US. And so whether you're investing a couple $100,000 or tens of millions of dollars, we have to have this suite of products to offer all client bases, which is fun.
How do you organize that entire effort?
All of it stems from how do we build great portfolios? And in the private markets, we think about allocating our portfolios, half to 70% of it every year is in core private equity. 20 to 25% is in growth equity and venture. Mostly growth equity, although we've been leaning into venture the last couple of years. 15 to 25% is in private debt offerings. We've been doing that since 2007. And then real estate, real assets, I would say more broadly is another 15 to 25%. So we kind of start the year, and we always try to think of a few years ahead, but we start every year by saying, do we have enough choice in these areas to build portfolios? And then, like I said, clients can we can do it for them, we could do it with them. A lot of clients actually do a combination. Like they'll get their core holdings and then they'll invest a la carte as well.
If you take the asset allocation higher up than just alternatives, What does that look like on the platform?
We run a family office report. We started it a couple of years ago. We're in the process of updating it right now, where we go to the top 200 families. But I would actually say about 25% of it was in pure equities. 46% of it was in alternatives, which surprised me. And the remainder, about just over 20%, was in fixed income. I started the family office side because I think it's fascinating to know that within that 46% of alternatives, 15% was in direct real estate, 17% was in private equity funds, 6% was in hedge funds. And it's a public report that we put out there. If you look across our broad client base, I think a lot of clients were 60-40, 60 equities, 40 fixed income. And I would say across the board, it's probably now changing to maybe 45% equities, 15% in alternatives, and the remainder still like fixed income and where you put private credit and which side, it will depend. But generally speaking, that's how it's been.
With such a wide range of clients, how do you organize your effort to create those portfolios and service the very many different clients that you have?
It's all going to be based on client needs, which everyone's going to tell you, anyone that serves the clients in these areas. Because a client that's a business owner is going to be very different than a financial institution type client. That's going to be very different than someone that's inherited wealth and trying to thinking about how to preserve it. But we do have goals-based planning that we try to understand the needs of a client's portfolio. Do you want income? Do you want higher returns? Do you want a mix? So it all actually and I'm going through the process now as a client to figure out like what are the goals in your portfolio. So I'm answering a bunch of questions. They put it in a proprietary system to figure out what the output of that is. And then how you actually want to make decisions and invest will come after. And so then how we get organized is we have a whole group that's all about understanding the client. How do you actually make the decisions of building and preserving wealth over time? What are your goals? We have a whole separate group that then they speak to say, what are the components of how we build those things? Do you want to do it yourself? Do you want us to do it for you? All that. And then from the investment standpoint, we have an entire solutions group that we sit at the table formally every week debating like, I would argue with the credit folks for many years about like the value of private credit versus public credit and the value of private equity versus public equity. And so we sit down as a global investment strategy team to sort of decide what our views are. There's a lot of different models in private banking, right? You can do, or wirehouse models where you have a broker that's deciding at that unique level. We do a more unified approach to building what our views are and then letting clients figure out implementation themselves. And then we also do a daily morning meeting from 8 to 8:30 where we just break apart the markets, figure out what we want to focus on, ask questions like, is now the time to invest in Mag 7? Or is it still, should you still be thinking about outside the US and stuff like that? But that's a little bit of how it comes together.
So within the alternatives,
yes,
how do you go about the manager's research process?
So we have just over 200 investment professionals. We have specialists that lead every sector, and they're building market maps for where we want to invest. And we have an entire investment review committee process where we're understanding who these managers are out there and what needs they're filling in portfolio, but also the uniqueness of the trade-off in the public side versus the private side, right? Most institutions fill a bucket. They say, I want to invest X amount in private equity or private credit. Individuals don't. They just want to know, like, what are the absolute returns? So we made a decision in 2013 to stop investing in some of the mega cap buyout funds because we felt like returns were coming down. So we do have a little bit of a macro view as to where future returns are going to be. We build our own long-term capital market assumptions across every sub-asset class, liquid and illiquid. And then we scan the market to say, can we build a portfolio this year? I'm mostly focusing on the drawdown side right now. The world of evergreen funds are changing all of this. But I would say we have about 45 individuals that are specialists in their unique area of underwrite that are building market maps that we're reviewing on a weekly basis to figure out, are there new themes or areas? Are there people that can build consistency and a track record? And then we put them through what we call diligence. The managers might call it torture, but there's a whole process. And I would say once we commit to doing something where we want to make sure that there's either a portfolio need or client demand, it's probably like a 12-week process of like serious underwrite. And then actually a big chunk of that process is what are the numbers not telling you? Or what are, from a background check people side, like who do you want to be in business with for the long term? So it's a pretty rigorous process, but everyone tells you that. I would say if you speak to many of our managers who you've had on your podcast, they would say it's pretty intense just because we try to figure out how they're going to treat us in good times and bad. So we'll call their worst portfolio company and their best portfolio company and try to see the difference between the two.
So if you looked at some of those subsectors, and maybe just grab private equity as an example,
okay.
What does a market map of private equity look like?
After 2021, we recognized that our clients, those who were choosing a la carte, were overweight growth allocations. So we said, should we be investing behind value? Should we be investing behind, and when capital markets started closing up in 22, we said, should we be allocating to more the mid-market, right? They use a little bit less leverage, maybe 2 turns less on average. They have more exit opportunities. They can potentially buy cheaper depending on what their skill set is. So we'll do a market map that says who are the 15 managers that are raising capital today that meet our minimum return threshold for a lot of these searches, that are willing or wanting to partner with us, like want the diversification of private bank capital. And we look through it together, and then we literally go out and just meet all these managers. The last couple years, we are investing in places like Asia, about 10% of our portfolios, even though on an a la carte basis, there was less demand from clients. Same thing in growth and venture over the last 2 to 3 years. We were still making sure it was 20 to 25% of the portfolio, even though a lot of folks were digesting what they'd done in 2020 and 2021. So the market maps will say, how do we make sure that we're investing to build a portfolio over 4 to 5 years to make sure that every piece is complementary to the existing piece? But you also don't want to work with 5 managers in the same space that all come back to raise capital at the same time, because then you can't have your capital matter to them.
Now, how do you think about either the I don't know if you call it an approved list or what's on the market map?
Yes.
If you're looking at what's happening this year compared to what's been
Prior
invested
years?
in by the clients prior.
Most of what we've invested in, we're keeping in significant contact with these managers to watch every investment that they're making. Are things shifting? Are they doing what we underwrote them to do initially? Folks are questioning this concept of U.S. exceptionalism right now. And so some stuff outside the U.S. has helped us. So we'll just make sure that we're not overweight to any of our long-term targets that are really over 4 to 5. Because we always tell clients, try to build over 4 to 5 years. If you only invested in 06, 07, 08, you would not like me. You would actually hate me, because those private equity managers are trying to exit most of their positions post-crisis, like during the crisis. So we try to say allocate over 4 to 5 years. And a lot of what we're doing is making sure that there's no sector overweight beyond really like 25%. Tech is the one thing that's changing, because we no longer really see it as a sector. It's a horizontal, right? But we'll just and then we also do like a deal overlap. I think there's a lot of questions about that in places like private credit. Like people have asked, are all the private credit managers in the same deals? We feel like we started in the upper mid-market, even large cap, you could say. So our next manager was in the core middle market. You go from having an EBITDA average in your portfolio of 200 million to 75 million. And then the question is, do we go to lower middle market? Those are the debates that we have on an annual basis.
How do you think about the size that a manager can deploy?
Size definitely matters, right? That was a mistake of a lot of what happened pre-crisis, pre the GFC and then post the great financial crisis. I would say, though, there's some of these managers that everyone would always say, how can you raise $15 billion or $20 billion and deploy that appropriately? But if you look under the hood to figure out, have you increased the size of your team? Has your deal size changed? Have your return drivers changed? Have the partners changed? There's a whole generational shift happening in the world of private investments right now that we're talking about. So I would say the size doesn't totally scare us. We do try to think, what's the expectation of you to persist from a return perspective? So if you look at the private equity industry, I think the data tells you that over the last decade, half the returns came from multiple expansion. That's not good or bad necessarily, but that's not going to persist. So where we've always focused in core private equity, as an example, is managers that can drive 3/4 of the return from proper operational improvement. Driving earnings, driving revenue, and thinking through, if you do cut costs, is that good or bad, and do you invest it back in the business? So I would say size doesn't totally matter, but in our portfolios, there were these shifts that we made, like in 21 and 22, we started moving more into the core middle market. And in parts of our business, like our private equity group that's been investing for over 40 years, they've stayed focused on the funds sub $2 billion. Like that was always the sweet spot of what they did. So we try to give our clients choice. We do think that, middle market can outperform large cap, and smaller funds can outperform bigger funds, but there's such dispersion. It's all about the manager selection process. It's even more exacerbated on the hedge fund side, but size isn't as much of a factor.
How many different managers would you say in your, say, just private equity will your clients invest in? We have offered over 200. There's about 85 to 90 active relationships that we have in the broad private bank offering. The concept of concentration in the industry is happening. There's a lot of acquisitions that happen to some of these managers. But I would say, even if we work with a great manager, could be a public manager that has many different arms of their
organization, we really don't do everything that they do. You know, like we're not going to be a suite to offering the entire GP. We really want to focus on where are you the best and having our capital matter to them and then to our clients as well.
What are some of the things you've seen that are the subtle differentiations between where you think a manager is great compared to another one that is good?
People are what matter the most. And like I feel that way partly because that's what we think at JP Morgan too. But I do think you can tell those subtle differences when you're meeting these teams over and over again, like how they communicate with each other, how they talk about winning deals together, the consistency of how long a partner's been there. We do partner attribution analysis for all these fund managers, but there's usually a story behind all of it. So I do think the people and the culture totally matters. There's one firm we work with that when a person at the top of the house gets close to the age of 60, they like choose to pass on their career to the next generation. And so it's led to them being a very big shop and continuing to have multi-generational exceptional performance. So I would say the people thing is definitely part of it. Second is just how they articulate how they've driven performance in the past. Like you can quickly tell what they think their competitive moats are in those situations. And then if we invest with a private equity manager, we typically go to all the private credit managers and ask how they treat them. So there's like that kind of, how do you treat your lender, which we obviously as a bank care about. Sourcing is certainly what differentiates, especially in some areas that are getting more and more crowded, like private credit. I think that'll be one of the bigger hurdles on a go-forward basis. And then knowing those stress points in the market, like how you treated your partners across the board. Those would probably be the three things. And then how the consistency of how they've driven value and whether we think it can persist on a go-forward basis.
So you turn over to private credit, the structure of where assets are flowing in private credit is totally different, much more concentrated. How have you thought about that and bringing that asset class to your clients?
I would say there was certainly differentiation as this whole shift was happening out of the banks and into the private markets. A lot of people talk about how new this asset class is. We don't think it's new. We just think it's shifted. Although I did see within the overall private credit industry, you now have to differentiate between direct lending. So you think of the corporate private credit market, I think someone said something like $3 trillion and $1.5 trillion has been raised. But then you look at asset-backed lending, and it's like over a $20 trillion market by a lot of accounts, and only $500 billion has been raised. So all these things are shifting. But if we started on the direct lending side, and we started with large-scaled managers, that's where we thought there was going to be a benefit to not just having beta, but also generating a little bit of alpha. And it makes sense. Most of those individual companies want to deal with one lender in a time of crisis. So we've skewed on the direct lending side towards larger-scaled managers. And I would say as that market continues to evolve and as the banks start to get back into some of these areas, we do think returns are going to come down, probably by about 200 basis points on average. And then in the opportunistic credit side, we actually like those that can focus on microcycles to be smaller managers. So we think that they can drive significant alpha, that they don't need a broad distress sell-off for them to generate returns. I do think the market and most allocations are overweight direct lending and don't have enough of the opportunistic credit. I think there's good reason for that. I think there were time periods where folks were overexposed to the more cyclical subsectors like energy and consumer, and so they got out of that space. But I also think the recent years, there's been an overconcentration in some sectors like software and others that we have yet to see how that plays out. But I would say, but we focused initially on the direct lenders we'd always done some opportunistic microcycle trades. Like coming out of the crisis, we did commercial mortgage-backed securities, residential mortgage-backed securities, non-performing loans in Europe, where we're focusing now on some of the like more asset-backed lending, or if I can be a lender in sports media entertainment. Like there's some of these subsectors that are really fascinating to us where we think you can still get a premium over just generic private credit.
You mentioned starting to invest more in venture. How do you bring something that historically has pretty tight capacity constraints into a large-scale platform?
We did some analysis because we hired someone to lead our venture and growth initiative maybe 7 years ago. In 2012, 2013, when sort of the hybrid crossover market and growth equity market really started opening up, because we only had a couple managers. He came in maybe 17 or 18, and he said, you're doing a lot of like the late stage growth, which has worked. But he actually had this view that the best if you really wanted venture returns, and we know that if the dispersion in private equity is 17% between top and bottom quartile, I think in venture it's something like 27%. So it's much bigger. So you probably shouldn't invest unless you're going to get access to some of the best. Well, a lot of people assume that the best were like the best names, the longest term names. And he had this view that it was really funds that were between $50 and $250 million. But a lot of our clients, to your point, can't just allocate capital. The venture firms aren't going to be able to grow with you. So there's places like venture where we'll build portfolios. It's one of the places that we do tell our clients to consider fund of funds. There are some that have gotten over the concept of fund of funds for core portfolios. But in venture, it's certainly somewhere where if you can't, like, it's one of those things that's hard to do yourself, pick and choose, not to mention the choice isn't available. And you don't want to work with the firms that just need capital. And then I think the question is, on a go-forward basis, what does venture look like? Because I do think a lot of these venture firms are not, you would look at the checks that they're putting in and the stage that they're in, and you wouldn't really say they were traditional venture. You'd say they're multi-stage. So we'll see how that evolves over the next 2 to 3 years.
Then even if you're doing it on behalf of clients, you're still managing a large war chest compared to the potential opportunity set. So how have you gone about trying to get access to the funds you think are important to have in the venture side?
In the private equity group, they've been investing. They were day one investors probably in 8 of the top 10 since the beginning. So they've had super long-term access. And if you look at our client portfolios, when we did this survey, even for the largest families, venture allocations was still less than 5%. It was 4.85%. So we do have a big client base. We do have a lot of capital at work, but the allocations are still small. There's other parts of the venture market that are opening up, like secondary venture. So a lot of our clients love that area because you can build diversified portfolios, and there's only a few managers that do it really, really well, we think. But I also think we're at this point in venture where everything's changing, where there's a ton of spin outs, and there's just given the market environment over the last couple of years in terms of valuation reset, the dollars available versus the dollars that are being raised. So I think how we talked about venture 20 years ago versus how we're going to talk about it for the next even 5 or 10 years, I think will be drastically different. But I think a lot of it is the banking system as a whole changed the way in which we serve venture. And when we acquired even like First Republic, it opened up our eyes in terms of like a lot of those clients within that community. And I just finished a conference of our, top 82 founders and top 50 sort of venture growth managers. And we're building this ecosystem on this innovation economy that I think everyone from Jamie down to everyone that covers these clients really believes in. So TBD on a lot of this stuff. But
how do you think about that integration of access to top founders, access to all these billionaires you manage capital for, and bringing the relationship capital and the intellectual capital into the investment process?
The fact that we're one of the biggest spenders of technology as a firm helps us understand the product. I think we spend over $800 million on cyber every year to keep our clients safe. That gives us really good intel into a tech manager or a cyber manager that's telling us that they have a great product. Having just been at this event, there were a lot of people that were the founders themselves who said, one of the best places to test your product is JP Morgan because you have such specialists in these areas. So I would say in that ecosystem, we actually use a lot of the bank's knowledge to understand the products. And then we figure out the luck versus skill, what did they bring to the table? How did they add value to those companies? And how did they build portfolios over time? Because we do also allow our clients to invest direct to cap tables for a lot of these investments. And so I think a lot of it's just, I think the total number, it's trillions of dollars that we spend in technology spend overall. There's some sectors like healthcare in the VC market where, given our healthcare practice, we can really understand which businesses are going to scale longer term versus be a feature versus a actual product.
How do you organize the information, say, from that frontline conversation with the founder to the manager research person who's having a conversation with a healthcare VC?
A lot of people say we have X number of meetings a year. And we do. We have our investment professionals, we've tracked for the last several years over 3,000 meetings a year. There's a lot of people that do that. But most of the time at JP Morgan, we joke that it's bringing the JP Morgan bus. Like it's people like myself that work with clients. It's the portfolio manager. It's the due diligence person that we're all building and learning together. That sounds very inefficient. But in practice, it works. Just the way in which we run discipline around trying to give quick no's and spend time on the longer yeses and how we do it. But I would say we can pretty quickly distill down who are like our top 15 to 25 targets in a certain area or the companies based on some of the cross-line of business partnerships and so forth.
How do investment decisions get made?
Our diligence team will bring a fund manager to investment review committee every week. And we'll have 2 to 4 managers that are presented on a regular basis. It starts with our investment review committee process, which we have an entire presentation about whether it's people, philosophy, process, and how do you generate consistent alpha over the long term, all the things that you'd expect. We have our own in-house operational diligence team. That's a big part of it. Like you can have a great investment, but if you're not operationally set up to do it, it's going to be hard for us to invest. We kept all of our structuring in-house, whether we set up a vehicle or whether you could be direct to the fund. But I would say like the actual investment decisions, it's rare that you get to investment committee and something's a no because you've already worked on all these processes before then. But I would say it's matching the, can you deliver your historical returns on a go-forward basis with demand? Like there are great ideas out there, but if clients aren't allocating to a certain space, I don't want to waste either side's time. If we invest, let's say if we invest $30 billion a year, I would say 10 to 20% of that is managed by us, where we can build a portfolio that our clients trust in us. And then the rest is right now based on where there's client demand. That's going to shift over the years ahead. I think more and more clients don't want to have to choose between manager A and manager B. Similar to how we build their overall portfolios, they just want to say, do you think that this can meet my long-term needs? And if so, I trust in you to build something for me.
When you aggregate all the investment activity you're doing, there's a lot of market power you're bringing to bear as a big investor in the space. How do you think about the right level of extraction? So you could think about that as a fee discount for your client. You could think about it as a partnership with the manager where you're kind of part of a GP.
It'll depend on every subsector, obviously. I would say private credit's a good example of where, when you invested 10 years ago, you would make sure that you weren't paying on committed capital, you'd pay on invested capital. But even so, as the returns come down, so should the fees. And so I would say in a lot of those, we're always focused on the net return. And then we're making sure that whatever the economics that a fund manager is driving is truly either for their business or for future investments. We rarely take like GP economics. We do from time to time, but we're mostly focused on how do you generate the best net returns. If we're going to bring in institutional like size capital that we want to make sure that we get most favored nations and that discount, we'll work hard to get those for our clients because we think it's appropriate. Though you always want to balance the like not pushing a manager too hard on that because you want to make sure that if they have a new generation of partners that are coming up and they're waiting for the carried, like in venture and growth, you don't get a lot of that carried interest for several years. So paying a higher management fee is more appropriate. But then making sure that there are step-ups in economics, I think, is important. So I think it'll depend on each sub-asset class. I think lower returns, we obviously are going to continue to drive returns. Economics lower, I would say for the higher return-oriented places, it's just understanding what the waterfall is going to be. Oh, and sorry, one more thing on that. I would also say when there's opportunistic trades in the market. So there was one of our greatest partners in the technology space that in March of 2020 wanted to make a call on more liquid markets. We created a structure with them that was a 0 and 20 structure. So 0% management fee, 20% incentive fee that got struck at the end of the fund life. And the reason we did that was because we felt like it was more of a beta play. But there's still a lot of clients that in March of 2020 didn't invest in tech stocks. We could raise $1 billion in the matter of days, get that invested in the market. It was supposed to be a 2-year term. A year later, that manager said, the opportunity set's mostly played out. And so they distributed in kind the top 10 stocks and got it back. But I bring that up because how you build, most people just look across the industry and say, am I somewhat in line? But then if you really want to be, a great partner to us and you see those opportunistic type trades, it's making sure that clients love alignment. Like as most people do, but especially in opportunistic trades is aligning the economics to whatever the opportunity set is.
How do you think of layering in taxes?
Well, I'll start by saying we don't give tax advice. So it's interesting because there's two sides of the tax equation. One is the fact that just over 40% of the capital that we allocate to fund managers comes from non-US clients. So there are certain structures that in private credit are much more beneficial to non-US investors, like business development company, whether it's traded or non-traded, public or private. The fact that you're not paying the same effectively connected income as a non-US investor changes the entire return stream in terms of what you can. I mean, there were funds that on average in the direct lending space would take off 200 basis points of return if you were a non-US investor. BDCs help some of that. So there's structural differences. And then anything real assets oriented, real estate, infrastructure, right? They were part of that effectively connected income world. So a lot of that you can solve for in structure today. A lot of it, not all of it. For US taxpayers, we are, there's this whole shift that's taking place around asset location, not just asset allocation. And so it started in the long only side and even on the ETF side with some of these like smart tax aware strategies or tax loss harvesting and so forth. I think that's moving into alternatives. I think we've tried that in places like doing insurance dedicated funds, and there's differences between whether you want an annuity, a non-annuity. I still think there's a lot of work that needs to be done around that space, both educating clients, but also making sure that you have the right investments behind it. Someone did tell me once, like, just because you put ketchup on a meal and it tastes great, like if it didn't taste great without the ketchup, it's not a great meal, right? It's a bad analogy because I don't love ketchup. But the point is with taxes, I think we are trying to think about how do we build tax-aware alternative sleeves in places like hedge funds and private credit, and then just take what you can on the tax side for private equity and the equity-oriented solutions. But I think there's going to be a massive shift over the next couple of years. We, JP Morgan, have made some strategic investments on the technology side in firms like 55IP and others that can help us understand this. But I do think that we have a long way to go.
How do you structure, say, hedge funds in particular, which many of the strategies are tax inefficient, into something that might make more sense?
There are ways in which you can build portfolios of insurance dedicated funds that will help solve some of this. We've started doing that. So that's part of the answer. Part of the answer is also clients are putting these in their retirement accounts. There's limits as to how you do that. But I always go back to what's your funding source and what's it solving in your portfolio. I think if you asked us 10 years ago, the funding source for most hedge funds was equity. And that's completely shifted. Even in our portfolios, the funding source is fixed income. And so if I can try to earn equity-like returns with fixed income volatility, even when you consider taxes, I still think that you can get a premium over just traditional fixed income. And the purpose of what it serves in your portfolio. Even though stock bond correlations have come down most recently, we've just come out of a period where they certainly didn't provide the same diversification. And so I think we try to focus less on taxes. There's enough evidence that gives us confidence to continue to invest in uncorrelated hedge fund strategies, be aware of the taxes, but not be overly concerned if it truly adds portfolio diversification.
Interval funds have started expanding in use, particularly in the private wealth area. What's your take?
We hadn't done much up until recently. We are creating our own. As the industry evolved in private credit, which is the main source of the interval funds, I would say we preferred tender offer funds versus interval. We preferred the concept that in some of the worst market drawdowns that a fund manager could, or a board could say, it's not the right time to sell, right? I do think that the industry has now evolved and it's big enough now, it's mature enough to think that there are appropriate interval funds out there. And as a portfolio manager, if you're managing a portfolio of underlying funds, you love interval funds because you know that you're going to find some way to get that capital back. So I would say our view on it is certainly shifting over the last couple years. But I still think there's some places like in the non-treated REITs and other places where I'm glad that they had more of the tender offer feature to them. And I do think, again, making sure that I think a lot of people built interval funds to access the retail investor, and it came with a lot of fees and a lot of stuff in them. And we were buyer beware for a long time. There's more choice available, and so there's more competition from a manager perspective to make sure that the economics are appropriate.
How have you thought about the application of all of these alternatives into, let's just say, the chase side? So private wealth, but the lower end, not the large family offices.
A lot of these families that we serve and chase want to do the goals-based analysis, want to figure this out. But I think myself, Anton Pill, who oversees our entire global alternative investment solutions across asset and wealth management, we fundamentally believe that the access shouldn't be limited to those that, are the wealthiest. And so we want to expand that access elsewhere, especially if you consider the fact that the universe of investing, if you look over the last 20 years, people talk about the number of publicly listed companies has been in a significant decline. Or outside the US, access to these markets it's mainly the private markets. And so for us, we see this as a fundamental issue that if you want to get access to the real economy, you need access to private markets. And so we're gonna look to roll this out in the coming quarters, I would say, but we want to do it with the right structure, the right economics, and the right alignment from the GP's perspective. But our client base and our advisors that are giving us feedback in terms of how we build these portfolios are very excited about what's to come.
Why do you think this move is happening? And this move meaning movement of capital into alternatives. Why is it happening now compared to the noise about democratization or alts or the hedge fund structures 10, 15 years ago?
I think it's probably twofold. I think these could be totally wrong, but I'll give you my hypothesis. For many, many years, I had to convince great general partners to want private bank capital, individuals capital. And a lot of people just saw it as way easier to go to some institution, work really hard with a CIO, and get a $500 million check or $100 million check. And they didn't want to deal with all the administration of the tiny little tickets. We've been investing since the 80s and 90s. In the early 2000s, we really started going to some of the best GPs in the world to partner with them. And then it wasn't until, and they just did it as an experiment. They just wanted to try it out. They'd give you $50 million or $200 million. And then all of a sudden, 08, 09 happened. And there were certain asset classes like private debt and real estate that were ahead of the others in terms of accepting individuals' capital and appreciating that it was very diversified capital. The re-up rate for individuals is pretty high, but especially for a firm. I might not have the client re-up with you if you're a GP, but I likely have new clients that also want to invest. So the diversification aspect of it is a significant one. And then all of a sudden you run into a 2022 period where if you're an institution and you're tied to a mandate and you can't have more than 17% in private equity, it doesn't matter how good that GP is, you're not going to your board to get approval for the next fund, especially at a time where distributions paid in from existing funds are at the lowest level they've been at since the Great Financial Crisis. So the reason why I think most recently it's interesting is because, one, I think people are reminded of the diversification benefits of individuals' capital. Two, there's shops that are set up to be able to work that client relationship. There's also the structuring aspect where there's platforms that will do this for the GP so that they don't have to handle all the administrative stuff. So I think it's all coming together, technology, et cetera, at the exact same time with these new structures that are coming out there that are allowing people to invest and then allowing GPs to have other people take care of the admin for them.
Of the different structures, you mentioned interval funds. What are the things that you think will get the most traction in that space?
If you look at fundraising across the industry, on the drawdown side, it's been in decline the last 3 years. If you look at my business, it's been up. Last year surpassed even 2021. So I do think, again, more clients coming into wealth, these access points opening up, the evergreen space, interval funds. There's been debate about what's the future of a lot of these drawdown spaces. For managers that are in what I call no man's land, and this is what I mean by that. Your returns are somewhere between 11 to 15%, 11 to 14% net returns is what you target or what you've delivered. And you are looking to lock up your capital for 10 to 15 years. And no one ever ends on time, really. But if you're in that zone, for individuals and taxpayers, there's not a lot of bid for those type of portfolios, unless it's super diversifying or very niche oriented in terms of what a client's looking for. Because many people would rather accept 8 to 10% returns, go into these private market evergreen portfolios, and compound that money and not have to make new investment decisions every 2 to 3 years to recommit to a fund manager, and not know when you're going to call capital or distribute capital. And if they trust in you, they just want to keep investing. They want you to do it for them. So I do think these evergreen portfolios are solving, I'm not going to say problems, but a lot of the annoyance of allocating to traditional drawdown funds. And that's why I think the momentum is just going to continue from here.
When you talk to a client about the choice of an evergreen fund or a drawdown vehicle, what's your expectation of the return dilution because of the liquidity provided by the evergreen fund?
Most of these fund managers in the private market evergreen space, I think there's still less than 500 of them that exist today, hold anywhere between 15 to 25% in liquid securities, and they do charge higher fees. In certain areas like credit, it's actually pretty minimal different. Like most of our senior secured direct lending, we've moved almost entirely to evergreen portfolios. In private equity, I would still say our first thought is start with a drawdown fund for most of the managers that we're looking at, and then think about the evergreen portfolio. But I would say return dilution is anywhere from 200 to 500 basis points. The question is it really dilutive to you? Like, were you investing the uninvested cash? Because a lot of these firms make assumptions that your uninvested cash, you're still earning 6-7%, which a lot of people just don't. They leave it in cash because they just never want to be in a situation where they can't fund a capital call. So when we advise our clients about it, we first ask them 10 questions that are really about how do you invest your uninvested cash? How do you think about making decisions over the long term? How do you think about vintage year diversification? There's still a significant portion of our clients that only ever invested in one fund. And then they were like, we'll wait for it to see returns. And the J curve is a real thing that takes 3 to 4 years. And so more of the income-oriented things, we've moved towards the evergreen. We prefer the evergreen. So in places like direct lending, real estate, core plus real estate, and even value add a little bit, and an infrastructure investment, the core plus space, we prefer a lot of the evergreen strategies. And then in the more directional private equity, definitely growth venture, we prefer drawdown funds.
As more money comes in, as people start to look at these different evergreen fund structures, have you seen any change in the kind of traditional fees from the drawdown structures?
On the equity side, not yet. Credit side, we definitely have. Even over the last 3 years, we've probably seen about 25 basis points lower on the management fee side. And on the carry, maybe down 2.5% to 5%. On the private equity side, there's a lot less people that have enough levers to put into an evergreen portfolio and continue to invest and take in monthly or quarterly flows into their portfolio. So I would still say there's a premium being paid on the private equity side. Like most of these fund managers, you're paying, if not 2 and 20, slightly more than that, because they're still helping you from a convenience perspective of dealing with your uninvested cash and doing all that and getting access to co-invest in other areas of the market.
As you're talking to all your clients, what are some of the biggest trends you're seeing in how they're shifting capital?
The era of doing a lot of co-invest in the growth and venture space has sort of like gone away. And we didn't do that much of it. There were a lot of other platforms that had done a lot of it. And I think most of those things are starting to come to fruition. So direct investing is still less than, even of our largest families, is less than 5% of their portfolios, which surprises me because it takes up a lot of conversation because you get excited about those things. So they're moving more towards portfolios. I would say most recently, folks are, especially given all of the innovation taking place within artificial intelligence, like reinvesting again in venture and growth is certainly a top theme. In private equity, what surprised me is that people are moving back towards the core diversified holdings. The managers that are multi-sector are great operators by background and can drive returns. There's been a shift within that private equity line of our choice into the core diversified holdings. In private credit, people are starting to think about other sources of income, not just direct lending and having corporate exposure there. And then I would say hedge funds, we went from a period in 2014 where we made a strategic asset allocation shift downwards in hedge funds as we thought that rates were going to stay lower for longer. So our strategic asset allocation is 10%. And that we had sort of negative flows for a period of almost 7 years. And then in 2019, 2020, we saw flows come back into that market. And we've seen significant flows accelerate since then. So the shift towards building portfolio resiliency in areas like uncorrelated hedge funds, in places like real assets, those are some big shifts. And then the last thing I'll say, which is probably the first thing I should have mentioned, is the move into infrastructure investments has been pretty phenomenal. And part of that is because one of the biggest questions on people's minds over the last couple of years and still today is the future of inflation. And a lot of these infrastructure portfolios, you have 20 to 30-year contracts. You're in super monopolistic underlying subsectors of the economy. I know that I'll pay whatever my water bill says and whatever my electricity says, right? And a lot of the income is CPI adjusted. So for all those reasons, infrastructure has been a place that our clients have certainly leaned into. The institutional world got there almost a decade ago. Like, I think most of those institutional portfolios can be high single digits, even low double digits. They've replaced their fixed income with a lot of traditional liquid fixed income with that. And I think clients over the last 4 or 5 years have started to, and I think it's starting to really accelerate.
At the onset, you mentioned changing around how you went about your investing.
Yeah.
And I'd love to hear the different iterations of that and where you've landed today on the platform.
In 2011, we did this whole shift towards building portfolios for our clients. We looked at some of the data and we realized that when you made a portfolio decision versus a la carte, like, you helped clients building diversification. And then we learned a lot of lessons around investing in more cyclical sectors and longer term structures. We invested in Brazilian private equity. And even though we did great on a local currency, we did not do great on a dollar basis. And all things considered, we made a few mistakes, but they continue to inform us about how we actually want to build portfolios. So and then we would have maybe a dozen ideas a year, and now we have close to 3 dozen ideas a year. And we've hired a lot of people who have come from great organizations that come from portfolio building, and they've realized that in private markets, for example, the optimal number of funds in a portfolio should actually be between, I think it's like 22 and 27 funds, where as we've started shifting there and offering more choice, our clients were like, aren't you diluting returns? And it was actually very additive to returns. And then instead, we've added sector specialization. We started 9 years ago in real estate, 8 years ago in infrastructure, 6, 7 years ago in venture growth. But a lot of those shifts were really just like the lens in which we looked at the world in each of these places and then how we packaged it for a client. And you do realize that most families just want your best thinking and just want to know, like, how do I generate X? Like, if you told me that your target return over the long haul was 9 or 10%, which is going to be, U.S. large cap equities and long-term capital market assumptions, you don't need venture in your portfolio to achieve that. So we've just kind of shifted into recognizing that, like, we can build great portfolios. We have great choice. It does come with diversification underneath and having multiple skill sets. And it's not just, as the world's opening up, it's not just allocating to primary funds, it's allocating these evergreen portfolios. It's not just allocating to primary funds, it's allocating to secondary portfolios. Some of these markets are opening up in a way that we wouldn't have imagined 15 years ago.
What initiatives do you have on the come that you're excited about?
We've spent a lot of time lately on themes outside the US. So whether it's places like Japan or places like developed Europe, I would say sports media entertainment is a ecosystem that we as a bank have a lot of intelligence in, both from our clients and our overall capabilities in that space. But as those markets open up to private market investors, at the end of last year was things like the NFL opening up. There's a lot of things changing in baseball, hockey, et cetera. And it's a place that our clients understand and are really interested in. We have favored more of the lending side to the equation. I think we'll probably make some investments on the equity side. If you believe that volatility is here to stay, the concept of thinking through portfolio resiliency, like when we came out with sort of our outlook for the year and the things that we were most focused on, it was the number one most clicked thing out there. Like, our clients are really trying to think of, understanding the concentration in public markets, especially in things like the S&P, understanding the role that equities and bonds play with each other, and figuring out where there's places where you can access some of these mega trends.
What are you most concerned about?
Clients understanding what they own. It's a big one, especially on the drawdown side. Meaning, we've done a good job so far, but I think that there's just, as more and more people come into a space and investing, it's just understanding what that is, making sure that you're buying things that actually are working towards meeting your long-term goals. Number 2 is, I do think when you think about all these markets opening up, there's still a lot of these that haven't been tested yet. And There are some places that are priced to perfection. There are parts of the credit markets that are, I won't say all. But having to sort of explain the differences, I think, is really important. And there's probably other things I'm not thinking about right now that I'll come back to. But
okay, I want to make sure I get a chance to ask you a couple of closing questions.
Oh, okay.
What's your favorite hobby or activity outside of work and family?
My favorite hobby, probably yoga. I was going to say paddle tennis because I'm like a Chicago gal and we love playing paddle tennis. But my husband is a serious paddle tennis player and I'm like not. So he'd be like, are you serious? That's what you picked. But if I had even more time, I'd probably keep playing paddle tennis.
What was your first paid job and what did you learn from it?
I was an intern at Morgan Stanley in our Lake Forest, Illinois office, which is where I'm from. And at the end of the summer, they offered me my bonus in cash or Apple stock. And I picked cash. It was the dumbest thing I could have done. So that was lesson number one. But I will say lesson number two, a year later, I worked at UBS for a neighbor of mine. And every morning, I was like the coffee girl. You could be a coffee boy too, but I was a coffee girl. And if you were good at it, they'd keep asking you to do it the next day. And every day, there were 7 orders for coffee. And one of the gentlemen wanted a half decaf, half regular with 5 ice cubes, 7 shakes of vanilla, and 2 tablespoons of half and half. That was his order. And I did it every day because I was like, they're paying me to go get coffee. This is the best. And then at the end of the summer, they matched my bonus with my entire salary for the summer. And they said, this is because you never complained once about getting the coffee. And so it was one of those lessons of like, sometimes people are just testing you in ways that you don't know. But those were my two first intern stories before I landed at JP Morgan.
How's your life turned out differently from how you expected it to?
Just better, always better. I don't know. I would have never imagined getting to work internationally. I would have never imagined being in the same job, same firm for 17 years. I've been with my husband for over 20 years since we were itty bitty. And then I have an amazing daughter and family that I'm really excited about and one on the way. So
if the next 5 years are a chapter in your life, what's that chapter about?
Professional, I truly think it's just the access to alternatives, because I truly think this is like a fundamental problem if we don't figure out how to give access to private markets and private companies to individuals when they think about their long-term needs and portfolios. So that's a cheesy and probably cliche thing to say, but it's truly where we're focused. And personally, just raising really good people. Like my daughter is a total sweetheart, but there's a lot of influences out there in the world for our children that I, whether it's Jonathan Haidt or others, that I like read about this anxious generation and what's to come. It does concern me. And so I just want to make sure that she's got a good life and the soon-to-be boy has a new life too.
Well, KK, thanks so much for sharing.
Thanks for including me. Nice to see you.
You too.